Sometimes the most dangerous thing in trading isn't losing money. It's the illusion that you finally figured the market out. After a series of winning trades, confidence grows quickly. Charts begin to feel familiar, breakouts seem obvious. Every price move appears to have a clear explanation. Before long, you start believing you've discovered something other traders haven't. Then the market changes. The same setup that worked perfectly last week suddenly fails. Breakouts become false signals. Trades that once felt predictable turn into losses. At first, you question your strategy. Then you question the market. Eventually, you begin to question yourself. This is where real trading begins. Professional trading isn't about being right all the time. It's not about finding a magical indicator that predicts the future. It's about staying disciplined when the market does the exact opposite of what you expected. That's what makes this book different. Instead of promising a perfect system, it takes you inside the mind of a professional trader. It doesn't hide losing trades, failed breakouts, emotional mistakes, or difficult decisions. It shows how an experienced trader thinks, manages risk, and stays consistent through both success and failure. Peter Brandt spent decades trading the commodity markets. While he's well known for his classical chart patterns and strict risk management, the real value of his work isn't the patterns themselves. It's the honesty with which he documents his decision-making process. You won't find guaranteed setups or shortcuts that work in every market. Instead, you'll learn how a professional evaluates opportunities, defines risk before entering a trade, accepts losses without emotional reactions, and focuses on the process instead of individual outcomes. One of the biggest misconceptions about trading is that success comes from better analysis alone. Many traders believe that if they can read charts perfectly, profits will naturally follow. But even great analysis becomes useless if you take oversized positions, move your stop loss, exit winning trades too early, or chase the market after a loss. That's why trading is more than charts. It's a test of discipline, patience, emotional control, and decision-making under uncertainty. The market will always be unpredictable. You can't control what it does next. But you can control how much you risk, when you exit, and how you respond after every trade. And in the long run, that mindset is what separates professional traders from everyone else. Many people believe successful traders can predict the market. In reality, professional traders think very differently. Before they analyze a chart, they analyze themselves. They understand that a chart tells only half the story. The other half is the person making the decision. Two traders can look at the exact same setup, enter at the same price, and still end up with completely different results. The difference isn't the chart, it's their behavior. One trader sees a small profit and exits too early out of fear. Another ignores the original plan and holds on for too long because of greed. Some traders panic before their stop loss is reached, while others refuse to accept a losing trade even after the market clearly proves them wrong. On the surface, both are trading the market. In reality, they're trading their emotions. This is where the professional mindset begins. Professional traders don't see themselves as fortune tellers. Their goal isn't to predict every move or prove they're right. Their goal is to identify situations where the risk is clearly defined and the potential reward justifies taking the trade. They know that every setup can fail. That's why, before thinking about potential profits, they first decide exactly where their idea becomes invalid. If the market reaches that point, they exit without hesitation. This sounds simple, but it's one of the hardest habits to develop. Human nature craves certainty, especially when money is involved. Once capital is on the line, the mind starts searching for confirmation. It looks for news, opinions, indicators, and social media posts that support the trade already taken. But the market doesn't owe anyone confirmation. A breakout can become a powerful trend, or it can fail within minutes. A chart pattern can look perfect and still move in the opposite direction. That doesn't mean technical analysis is useless. It simply means analysis provides probabilities, not guarantees. Professional traders understand this difference. They treat every setup as a possibility, never as a promise. Because of that, their confidence doesn't come from predicting the future. It comes from consistently following a disciplined process, regardless of the outcome. A losing trade doesn't automatically mean you made a bad decision. If you followed your plan, controlled your risk, and executed your strategy with discipline, the trade may still have been the right decision even if it ended in a loss. On the other hand, A profitable trade isn't always a good trade. If it was driven by emotion, ignored your rules, or relied on luck, it reinforces habits that can become costly over time. This is where many traders go wrong. They judge every decision by the outcome. If they make money, they assume the strategy works. If they lose money, they abandon it and start searching for something new. They jump from one indicator to another, switch between time frames, chase different trading styles, and constantly look for the next perfect system. It feels like progress, but often it's just a way of avoiding uncertainty. Mastery doesn't come from constantly changing your approach. It comes from repeating a proven process long enough to understand when it performs well, when it struggles, and under which market conditions it has the highest probability of success. Consistency doesn't mean refusing to adapt. It means making changes based on evidence, not emotion. A few losing trades shouldn't force you to abandon your strategy. Likewise, a winning streak shouldn't convince you to increase your risk without a valid reason. Professional traders treat trading like a business. Every business has expenses. Some ideas fail. Some opportunities are missed. Success comes from keeping losses manageable while repeating a process that has a long-term edge. Trading is no different. A stop loss isn't a sign of failure. It's simply the cost of protecting your capital. Once you accept that, losing trades become much easier to handle emotionally. Instead of seeing every loss as a personal defeat, you begin to see it as part of doing business. No strategy wins every time. No trader is right all the time. The goal isn't perfection. The goal is staying disciplined long enough for your edge to play out over hundreds of trades. That's how professionals survive, and that's how they succeed over the long run. Money naturally triggers emotions. A winning streak can make you overconfident. A series of losses can fill you with doubt and fear. Professional traders don't eliminate these emotions, they simply refuse to let emotions make their decisions. That starts with preparation. Before entering any trade, they already know exactly what they're looking for. They know where they'll enter, where the trade becomes invalid, how much capital they'll risk, and how they'll manage the position if the market moves in their favor. These decisions are made before the trade begins, not while emotions are running high. Once you're in a trade, objectivity starts to disappear. Every candle feels personal. Every pullback looks like a warning. Every small move creates either hope or fear. That's why a written trading plan is so important. It protects you from making emotional decisions in the middle of the trade. One of the most common mistakes traders make is treating their trading plan like a suggestion instead of a rule. They move their entry a little higher because they don't want to miss the move. They widen their stop loss because they believe the market just needs a little more room. They take profits too early because they're afraid of giving anything back. Each decision seems harmless on its own, but together, they completely change the strategy. Eventually, the trader has no idea whether the loss came from the system itself or from breaking the rules. Professional discipline isn't dramatic. It shows up in small decisions made consistently. It means waiting patiently when there isn't a valid setup. It means refusing to chase a trade after missing the entry. It means accepting a stop loss without arguing with the market. It means following the exit plan even when emotions suggest doing something different. None of these actions feel exciting. But long-term success isn't built on excitement, it's built on consistency. The definition of success must change. Success isn't simply making money on a single trade. Success is executing a well-planned trade with discipline, regardless of the outcome. A disciplined losing trade strengthens your process. An impulsive winning trade rewards bad habits. Over time, the first approach builds confidence, the second quietly destroys it. Professional trading doesn't begin when you learn to predict the market. It begins when you learn to control yourself. Before taking your next trade, ask yourself 3 simple questions. Why am I taking this trade? At what price will I admit that my idea is wrong? If this trade ends in a loss, will I be emotionally prepared to take the next valid setup without hesitation? The answers to these questions reveal far more about your future as a trader than any indicator ever will. Professional traders don't waste energy trying to control the market. They know that's impossible. Instead, they focus on controlling the only thing they truly can: their own decisions. Once you accept that uncertainty is a permanent part of trading, everything begins to change. You stop searching for certainty and start building a repeatable process. You stop chasing perfect entries and start managing risk. You stop measuring success by a single trade and start measuring it over hundreds of trades. This mindset becomes the foundation for everything that follows. Every chart pattern, every trading setup, every risk rule, and every execution decision only has value when it's supported by discipline. Without discipline, even the best strategy eventually fails. With discipline, even a series of losses becomes manageable. That's the difference between surviving in the market for a few months and building a career that lasts for decades. Now let's shift our focus from mindset to the charts themselves. Every trader has seen familiar patterns like triangles, rectangles, flags, and head and shoulders formations. Many believe these patterns can predict exactly where the market will go next, but professional traders see them differently. A chart pattern isn't a promise, it's a framework. It doesn't guarantee a winning trade. It simply helps organize uncertainty into a structured trading plan. The goal isn't to predict the future. The goal is to define where opportunity exists, where the trade becomes invalid, and how much risk you're willing to accept before entering the market. That's the mindset we'll carry into the next chapter. A chart pattern has value only when it exists within the right market context. The same pattern can produce completely different results depending on where it appears. A continuation pattern forming during a strong trend may signal that momentum is likely to continue. The exact same shape inside a sideways market may simply be random price movement with no real edge. That's why professional traders never judge a setup by its appearance alone. They evaluate the environment surrounding it. Before entering a trade, they ask simple but important questions. Has this pattern had enough time to develop? Are the support and resistance levels clearly defined? Can the entry, stop loss, and target be planned before the trade begins? Most importantly, at what price will this idea be proven wrong? That final question matters more than the pattern itself. A chart pattern may give you a reason to enter the market, but your invalidation level tells you exactly when to leave. Many traders become emotionally attached to their analysis. After spending time studying a chart and entering a position, they begin defending their opinion instead of following their plan. When the market moves against them, they widen the stop loss, hoping the price will recover. They call it giving the trade more room. In reality, they're giving fear more control. Professional traders understand the difference. A wider stop loss is acceptable only if it was part of the original trading plan. Changing it after entering the trade without new objective evidence is no longer risk management, it's emotional decision-making. Another common mistake is entering a trade before the pattern is fully confirmed. Traders become excited by what they think is about to happen. They jump into the market early, hoping to capture a better price before everyone else. Occasionally, that works, but those early successes often create dangerous habits. An unfinished pattern hasn't provided enough information yet. Waiting for confirmation isn't weakness, it's discipline. Professional traders know that missing a trade is far less damaging than forcing one that never truly existed. Patience is one of the most underrated skills in trading. While waiting for a setup to develop, it can feel like you're missing opportunities. Prices are moving, headlines are changing, and other traders appear to be making money. The urge to take action becomes stronger with every passing minute. But professional traders understand that activity and progress are not the same thing. Waiting isn't doing nothing. It's making a conscious decision to protect your capital until the market presents a high-quality opportunity. Before trading any chart pattern, professionals define everything in advance. They know exactly what event will trigger the entry. They know which price level invalidates the trade. They know how much capital they're willing to risk. And they know they'll walk away without hesitation if the market proves their idea wrong. Just as importantly, they don't force patterns onto every chart. Most markets spend long periods moving sideways without offering a clear edge. During those times, the best trade is often no trade at all. Professional traders don't feel pressured to be in the market every day. They understand that preserving capital is just as important as growing it. Over time, they stop treating chart patterns like prediction tools and start using them as decision-making frameworks. A chart doesn't tell you what will happen next. It simply helps you prepare for multiple possibilities. It highlights where opportunity may exist, where risk must be controlled, and where your trade idea no longer makes sense. That shift in thinking changes everything. Instead of asking, "Where is the market going?" professional traders ask, "If the market moves against me, what is my next disciplined action?" That single question separates emotional trading from professional execution. The next step in becoming a consistent trader isn't finding better patterns. It's learning how to manage risk, because even the best trading setup can fail, but disciplined risk management gives you the opportunity to keep trading long enough for your edge to work over time. Every trader asks the same question before entering a position. How much can I make? Professional traders ask a different question. How much am I willing to lose if I'm wrong? That single shift in perspective changes everything. Long-term success isn't built on finding one huge winning trade. It's built on protecting your capital so you can survive long enough for your edge to play out over hundreds of trades. Risk management may not sound exciting. It doesn't promise overnight success or reveal a secret indicator. But without it, even the best analysis eventually fails. The smartest traders know that risk is never decided after entering a trade. It's defined before the order is placed. They know exactly where the trade becomes invalid, how much of their account they're willing to risk, and what position size fits that plan. A stop loss and risk are not the same thing. A stop loss is simply the price where you'll exit. Risk is the amount of money you'll lose if that stop is reached. That's why position size matters. A wider stop loss requires a smaller position. A tighter stop may allow a larger one. Either way, the total risk stays within a predefined limit. This approach keeps emotions under control. Oversized positions create fear. Every small price movement feels significant, making traders second-guess every decision. They exit too early, move their stop loss, or ignore their trading plan completely. Proper position sizing gives you the emotional space to think clearly and follow your rules. Winning streaks shouldn't tempt you to increase risk, and losing streaks shouldn't push you into revenge trading. Professional traders understand that confidence comes from consistency, not from the outcome of a single trade. The market will never be completely predictable, and no strategy wins every time. What separates professionals from everyone else is their ability to stay disciplined through uncertainty. They accept losses without panic, protect their capital without hesitation, and trust a proven process instead of chasing certainty. In the end, trading isn't about predicting the future. It's about making high-quality decisions, managing risk with discipline, and repeating that process over and over again. Because the traders who survive the longest aren't the ones who predict the market best. They're the ones who manage themselves the best.